Welcome back. Welcome back. Sorry for the tardiness, and we're getting started. Let me just pull up my show notes here. And I was waiting for Quinn to join on. Okay, just making sure we are ready to go. Let's take this off here. One second as we get through this. As we wait for a couple people to log in here. Let me get my media up and running. Alrighty. All right, sounds good. All right, ladies and gentlemen, thank you again for joining us on this week's Net Lease Industry podcast. Where's my ticker here? I got to get more organized. There we go. I like that look a lot better. All right, perfect. So yeah, this week, just like every week, going over this week's cap rate versus last week, just in case you are in the market or planning on selling or just kind of want to keep up to see what's going on in the market. So you just have some more information to make better decisions in the future, if it's not for net lease as well as for other retail investment assets. We're gonna look at where the 10-year is at. Again, it's jumping up and down depending on the time of the day, depending on the news and where we're at with that. We're gonna go over another batch of 5 frequently asked questions that's kind of pertaining to this week. So we try to kind of make it more relevant. And as we talk to a lot of investors on the phone and through outreach, we kind of gather all of this data and then we present it out to our audience and see if that also is going to be helpful as well. And then for this week, our educational segment is why lease structure matters more than cap rate. So again, that's kind of our ongoing theme is, we want obviously the highest cap rate, but we have to also make sure it's relative to what our goals, as well as the realities of the market and realities of the real estate that you're buying into. So to kind of kick things off, let's start with the cap rates of this week. And mind you, if anyone wants a copy of this report, we send out every Monday, but we can also print this off, send it over to you in a PDF. But also if there's any tenant specific that you want to look at, also let us know as well. And we can also organize that. And again, we're pumping a lot of data. So just kind of give us a little bit of grace as we try to curate it into different ways. As we get more feedback from you guys, you're telling us that you want to find that out in the specific regions, specific states and MSAs, and we can also manipulate that data and present that just so you can kind of get an understanding of what the trend is going on. And so you can be able to kind of see where we're at and kind of make better decisions as we move forward. So this week, and again, this is just kind of quick snapshot. We track about 170 tenants, all different sectors, auto, all the way to dollar store, to big box, to QSRs, to fast casual, to casual dining. So we're really looking at the data, but this is kind of like our top 25 main tradable tenants that we deal with. And, we get a lot of activity here. And again, as we enter more data, it's going to start to develop over time. So if you're looking for anything specific, because this, you have to look at this as, as we enter it in real time. These are all asking price. We got that before. So we do have closed cap rate stuff if we want to get a little bit granular, but for the most part, we're dealing pretty close to what we see here is what's going on in the market. And again, this also kind of changes as well, depending on the type of buyer and the situation. And we'll get a little bit deeper on why that is the case, on why the difference between the cap and, the closed cap difference level. So kind of going into numbers and just looking at it from last week to this week, not much, 5.79, this week 5.77 is about the same. And like I said, the data we put in is a minimum to about 8 years plus. So, and again, that's where our buyers are at. And obviously, we can add in more data that have lower and kind of add that in there, but it'll kind of skew it. And we try our best to kind of, because most of the time people are comparing this to other asset class or the treasury or just putting it to a bank account. So just give you some nuance there. So not much difference there. So essentially it's the same. And yes, we're not doing a quarterly basis. So we will, at the end of the quarter, we'll also compare that beginning to that end. So then you can see the big jump. But since we're doing this every week and we have, thousands of buyers on the list that are looking for properties, we would like to tend to kind of give an active snapshot. So that gives them just the current right then and there data so they can see, what makes sense to buy or sell. The investment grade, large grade, blue chip companies like McDonald's, Starbucks, Chick-fil-A still steady under 5. That hasn't changed. The Dollar General caps have been adjusting a bit. We're also seeing, we're still seeing a steady flow of new development come in as we start to survey our developers and see, what's on their dockets and what are their discussions that they're having with the tenants, and then see what it is from there. And compared to last week's discussion about tariffs and financial policy, mind you, a lot of those stuff haven't really sunk in. Right now, it's just the capital markets that's just reacting to the numbers, and for it to translate over to net lease and to start to kind of really have an effect is not. You're not going to see that for at least for a couple more weeks, a couple more months, as we see the policy sink in, and then we see inventory start to flip over, and then they're starting to, once they start seeing a little bit more data coming out of the White House, Fed, and other financial markers, that's when they start making forward plans. But as of right now, especially for the essential need, larger scale tenants, those are still consistent that we've been noticing. Let me see here. So buyers are still active, and we're still working with a large number of buyers, and not only just in 1031s, but just regular passive investors that's coming from the rental side. Jumping into the treasury, and when I did this report, we were at 474. What is it right now? Just checking. I usually go to CNBC. 432 right now. So that's where we're at with that number. Still over on average, net lease still is higher, and of course depending on the tenant. So of course that those still is trending up and down, as they're kind of baking in, and people are throwing out and, inflation and things of that nature. Again, we're going by just what the data says, no slant, and then seeing that what strategy moving forward, or to make you feel a bit more comfortable making the next move. That's where we're really trying to weigh in on. The financing side is still high. Where's my notes here? So I think it's give me a second here. Mortgage. Yep, all the way to 6.5. Yep, on average. And what is today's prime? Today's prime rate still 7.5. So again, if you want a referral out to one of our mortgage lenders, we primarily work with like Dave Simmer over at PRRS, and he can just kind of give you some up-to-date numbers and give us some scenarios. That's usually where we kind of send a lot of our clients over, just to kind of see where you're at and kind of see if everything makes sense as far as doing financing. But again, it's pretty high as compared to last year and 2 years numbers. Next, kind of went through that pretty quickly. Anyone in the chat, again, this is your show. Want to send in any comments or questions as we're going through this stuff? And mind you, if you just want us to send over some documentation so you can kind of digest this, 'cause I do have a slide for the educational piece, and I did have something that went over. Yeah, this is when I ran it this morning. So again, that's going to be adjusting. It's so that's why we can't really measure what you're going to do based off of that. You just have to look at what is your long-term investment goals and see what tenant, see what piece of real estate, what market makes sense, and understanding it's a long-term investment and that we're not day trading. So, oh, I should have put this slide up. Silly me. It was made it a lot easier for you guys. I'll also send this out. Plus, like I said, this recording is going to be posted on YouTube, so you can rewrite this. I mean, rewatch this later at your convenience. If we had caught you, when you were cutting the lawn or, taking your kids out to lunch or something like that. And yep, there it is. There's my number, 6.5 to 7.25. And we got a couple deals that we're working on right now that are getting financed, and they're all in different ranges, and they're between 35 and or 40 and 50 to 60% LTV. So highly leveraged buyers. That's kind of the name of the game. And in this market, like I mentioned, for people kind of looking to make a move, cash buyers have been gaining a leverage. We've been able to successfully, negotiate, really good terms because they said they see where the market is, and other buyers that are coming in, they're kind of muddying the waters as far as trying to be more aggressive with the asking price. And then the cash buyers been having leverage because they know there's more certainty as well as quicker opportunity to close for the seller. So again, our main thing that we always press on is, and that's all we deal with. For the most part, we never deal with any type of non-essential retail properties. So it's like 99% of our sales, and that's where the investors kind of see the value in, because throughout the different market cycles, those always make sense. So again, we could talk about any specific stuff where it's pertaining to a specific market, or it's just an exceptional tenant that has a great business plan that works specifically there. But for the most part, your best bang for your buck is going to essential real estate.
And
Um,
then just to piggyback off this, I talked to an investor earlier today. He had wanted to know, I mean, as for your experience, when he's a new investor, when it comes to financing, what do the lenders pay more attention to? Do they look at the more of the credit of the tenant, or do they pay more attention to the credit score, the power of the investor? Because he has capital that he wants to invest, but he just wants to know, based on your experience, what do lenders typically look at when he's doing financing for his first trip on that property?
all of the above. So it depends, but yeah, all of the above. You obviously, for any type of mortgage opportunity, you have to have favorable credit. The more better your credit score, the more favorable terms, the more you're putting down, the better interest rate, and of course, the real estate really have to make sense. Because again, you're essentially you're partnering with the lender. They're going to put out to put a loan for you to get on this property. They got to make sure their investment is protected, and it got to make sense. They want to know that you got a 10, 15-year term on the lease, that they're going to pay on the lease, and that's your ability to pay the mortgage. So yes, it's all a matter, but again, we always kind of encourage to just talk to one of our referrals that specializes in net lease, so they're very familiar with the product line. We work in close connection, so we can send them as much details as far as store sales. If it's like a corporate tenant, they know that their financials are publicly available. Um, they can underwrite the operator or the tenant to see if they're financially strong. They're seeing, how much investment into the real estate, if there's going to be a lot of deferred costs, the lease structure to make sure that it's a strong lease that protects you as the buyer as well as the lender. So there's a lot of different factors, and again, we're going to look at a lot of different deals to break down the different elements. But overall, all of the above. And again, that's in your best interest, that you want to find the best deal that makes sense. Also, that all the lenders will love to finance. So again, that's a case by case basis. So my recommendation, just always reach out to either someone you're working locally, or some people that are open on the market, that work specifically in this niche, or you can find some that are really good that is in commercial real estate in general. But it's nice that they know the product, know the type of investment, so they'll kind of know where you're coming from, and then you kind of talk about what your goals are, so then they can kind of structure a financing package that makes sense. It's one thing I've just learned from, this is a while back, from Dave, is that having that conversation early as possible is crucial, because some investors, obviously net lease is typically known for longer term leases, but some investors may want to sell in 2 to 3 years and sell it for either another asset class, or they just want to do something else. So you let them know that, so then they can kind of structure the financing around that. So in regards to prepayment penalties and points and different things of that nature, so it can really make sense. So you know your exit strategy before you buy. So that's kind of my recommendation, just to reach out, have that conversation, get stuff early, and get some relative numbers on the table. So then once we have it, then we kind of know what to work with, know where your target is as far as what you want to net per month, and then also your risk factors there. So it's a good question, but yeah, that's always kind of key, is just getting more information and being in the best position possible, is the best. Kind of finishing off this, I think this is slide. Yeah, it's my last slide. It's just don't panic. Every week, and this is really the main point of the show, is just to give as much information. And it seemed like it's just a whole bunch of stuff, and then you've seen stuff moving in different directions. It's just don't panic about it. Look at where you're at as far as what's your overall game plan, your strategy, and stick to that. And then we're going to try to find the best opportunities around that. We're going to see some pricings change over time. So there'll be some better opportunities later on, but it's never really the perfect time to buy. It's really just like what makes sense for your particular strategy, and couldn't you make the numbers make sense for you. Timing the market never works. Just go in and just say, hey, this is my objective. I'm looking to get 5,000, 10, $15,000 a month. I want a triple net lease. I don't want to have no landlord responsibilities. I want a great market with a essential need tenant. That's a great game plan. So now we have kind of your target there. Now we can kind of reverse engineer and then find that there. And of course, adding on the financing package and then adding on your tax strategy on top of that is just a really good combination. But if you come into it saying that, oh, I'm just going to wait where the timing is, yeah, you and everybody else is going to do the same thing, and then you're going to end up being on a bid list, and you're just going to be bidding yourself off, and then you're going to get frustrated. You're going to get out of it. So there's really no perfect time, and that's the same for real estate or any other type of investment. It's just what makes sense for you, and you make your plan around that, and then you see what investments can fit into that vehicle. And for some people, it may not mean that lease. You may need more of a higher aggressive return. You may have a higher risk tolerance. You may have a different period in your investment career. So you may take a different route. So again, we want to let people know net lease is traditionally conservative as far as its return. But the big, huge outside of it is that it's a very long-term lease structure, very conservative returns. And if you have a really good tenant, good piece of real estate, it could be something that make you happy for years to come. So moving on, so we covered caps, treasury, kind of sentiment on the market, and to kind of give a little bit detail, I kind of economic stuff, which we kind of touched on, and it's just really just to get people aware and to know, is we're seeing retailers starting to make public announcements as far as their strategies, like Walmart, Target, Dollar Tree, where they're saying they're going to be adjusting pricing because of tariffs. Consumer confidence, where we're seeing public polling about discretionaries, their sentiment on that, and of course trade negotiations and where we're at with that. So again, obviously, we're going to see these companies going to make adjustments, and like I said, the most public cases have been Walmart, Target. So what does that mean in the context? So yes, that could um, uh, cause impact on foot traffic, which then cause impact on sales, which then cause impact on ability to pay rent. I always say is that we're looking at it from a longer term perspective to see overall can that tenant withstand that that discrepancy and then be able to move it forward. A good thing to look at as we get a little bit deeper for those who wants to look that deep into it is where are most of these companies sourcing their products. So I mentioned like Target and Dollar Tree, where they have a large supply chain from China or some of these other countries that do have tariffs. So, and especially with the publicly traded companies, you can read their quarterly reports and their documentation and actually get kind of an idea. And there's a lot of data that's out there. And if anyone wants that's interested, we do have kind of a war room there where we just kind of track stuff, news reports, different data segments. If you really want to get nerdy on it and look into where these people are getting majority of supply chains and is it really going to affect their bottom line? Um, so we can look into that. What else I have here? And again, it seemed like it's a running theme, but I always go back to essential retailers. So grocery, pharmacy, auto parts, different stuff that are less reliant on imported goods. Those companies that have a nice, healthy, balanced supply chain will end up lasting longer. And the good thing about this is that it's starting the discussion. It's starting people to start shining light on it. So these companies are doing that, and they say, "Look, we're going to have to start really finding some balance here." Is it that easy? No, because for people to again switch over supply chains and plan out differences, especially when they have a certain uh, target carve out for their niche as far as pricing structure for their target audience. I mean, their target customer. So I understand that from that perspective, but it's giving companies more. Um, they're starting to react more to look at what do we need to do to make the changes so we can be more resilient, and that's really the end goal and the kind of the end target there. All right, what else do we have next? Okay. Yeah, we kind of talked about mitigating that and talking about what we should plan for in regards to trade, global. Okay. Okay, next, let's just jump into our questions, our Q&As here. Take this down. I'm going to put up my, this here. I'm going to queue that up pretty soon. So cap rate compression, a signal to buy or wait. For me is again, it's always, and it's the same stuff that we constantly talk about with buyers is that what is your end strategy, end goal as far as net cash flow, return on investment. If you're doing a 1031 exchange, primarily that goal is to defer your taxes into um, another like kind property and continue cash flow, as well as apply any available or all tax benefits for it. So we reverse engineer it. So yeah, we're going to see adjustments with pricing all the time from now into the future, and of course that's going to be effective for economic numbers, regulations, different things, performance of the tenant. So it really comes down to what aligns with it. Your high, moderate, or low risk investor, and just kind of seeing what your end game plan. So then we can reverse engineer to see which is going to be a good fit for you. So that's really what it comes down to. But yeah, there's always going to be adjustments, and just keep an eye on the cap rates as we kind of present them each week. And then we're at the end of the quarter, we're going to do a big reveal as far as beginning of quarter, end of quarter, but you get to see it on a weekly basis um, as you're active on the market buying or selling to see where we're currently at. It's kind of like a quick snapshot. So
AP, while we're on cap rates, can you just, I mean, we could probably do a report on this, but can you just touch on the realistic expectation on the what buyers are getting cap rates for? Like, so say, for example, if it's a 4 cap, and some people say they want a 6 cap for, obviously that's not realistic. But can you just give like the listeners like a range of, say if they put in an offering, what's a realistic range of what they could probably get the pricing guidance off of it?
yeah, I mean, it really comes because again, you have two parties. You have a buyer and a seller, and the pricing is determined on them making the deal. So could a seller uh, agree to a 6 cap? Have we seen cases where a seller has taken a over the market price on a certain an asset that was determinant on his motivation to trade the asset and so he can do whatever he needed? Like for example, we had a client where they needed to sell for a very unfortunate time and they had to liquidate. So that gave the buyer an opportunity to get it at a very over the market price. Is that usually the case in most cases? No. So pricing is between what the buyer and seller agrees. But then as far as pricing guidance, as what we see on when we run numbers, most people that are not in a traditional rush to make a move, they have the time to put it on the market, present it to a reasonable and available and capable buyer. There's going to be, of course, ranges, which is we call cap rates, that are based off of other comparables of other people that are buying, selling, and what's actively on the market. So as far as the expectation goes, we just have, that's why we run these numbers. So each week we're looking at where we're at, and we're constantly putting in asking prices of all of these assets. So in our system, and this is just for the past couple months, but I mean, there's thousands of properties out there in different, variation of stages. Ours just happened to be a collection of 8+ years left on the lease. So, so they range. And obviously you have like from the 7-Elevens all the way down to Wendy's. Then you have corporate back tenants, which tend to have a little bit lower cap rate, which means a higher value as compared to a franchisee, which may have, couple units to, 50, 60 units to a couple hundred units, like the very large ones. Then you have the McDonald's of the world, which are investment grade, corporate, publicly traded companies with large balance sheets, and they're very stable and have, very tight criteria on the real estate that they select. So those have higher value. And of course, there's valuations based off of how many that are available on the market. So Chick-fil-A, for example, they're not producing at a high clip as compared to Dollar General, where you may see them, right across the street, and then you see one down the street. So it's like they're popping up, all over the place as compared to Chick-fil-A. They're a little bit more strategic, a little bit slow in their rollout. So I always just encourage, let's just look at the data, because could you theoretically offer anything you want? Yes. Would it get a response? Not necessarily. So for us to set you up for success and to also get a realistic, potential negotiation, we may have to be within the ballpark. But again, it really ends up with the investor's goal or end goal at mind. What do they expect in return? Because if we say we're going to throw a 6 cap and it's listed for a 4 cap, that may not just be that might not be the right investment for you. You may either going to be a different tenant, different market, different location, or an entirely different type of investment altogether. You might be in multifamily. You get better returns on like an Airbnb or something for your money. Or in some of our clients' cases, they say, hey, I get a better return putting into my bank for the short period of time. So that's why the first conversation is always, what is your end strategy? What's your end goal? And then we're going to reverse engineer to say, hey, this is what's available with the tenants, what's going on with the market. would you consider this? And then we run the numbers and say this is going to give you $7,282 a month. Does that put you in a position where that makes you happy, makes your family happy? If that says, if the answer is yes, then say, okay, let's choose one of these that makes sense, and then go deeper with the market and the other dynamics, and we go into like deeper detail from there. So again, to put a bow on it is really aligning the investors' expectations, their goals, with the proper investment, and line that up first. And again, that varies. So, but it's not helping you to just say, hey, we're just going to throw a bunch of lowball offers, especially in a traditional, non-hurried seller situation where you're competing with other buyers that have open offers that will take it. So, so really just going down and just having that conversation to see what makes sense. So good question from that investor. So like I said, I would just encourage, just review the report. We'll send out a copy. If there was any particular ones of interest, we can break down the elements as far as state, region, to kind of give you what are people asking for and what the expectations are. Sometimes a question that spurs out of that is, what is really asked to close price? And I would say it's not a huge jump, because even if it's cash buyers that have the ability to close quickly, the seller would say, hey, well, between 45 days and 60 days is really not much to me as far as you having the ability to close. Yes, you may have a higher certainty, but then again, it's there's a lot of cash buyers in the market. There's a lot of 1031s on the market, and there's just a lot of trading going on. You're competing with 5, 10, 15 other buyers. You're competing with REITs. It's a whole bunch of different factors. So our job as the investment advisor is just to give you as much detail as possible and put you in the best position to potentially win it and then take it over the finish line. So that's really what it comes down to. And again, that also goes back to the first question of the compression. Yeah, we can look at the nuances and the details, but it really comes down to what is your end goal, and then we'll just find the proper investment that makes sense. And if people probably see that those are one of the first two or three questions we ask when we get you on the phone. It's like, what's your goal? And we try our ability to meet that. So good question. So the second one, pricing power, and Sunbelt and Midwest deals. So yeah, the Sunbelt, which is like where we're at, Florida area, Texas, all like that bottom part of the state, and you have the Midwest, the Ohio, Indiana. So they're different in pricing, of course, because you're dealing with lower or moderate rent per square foot in these markets. You're also dealing with lower or moderate construction costs, so that goes into it. So you kind of weighing in on that, and of course the cost of living is different in these markets, tax policies, business friendly. So there's a lot of different factors. So it really comes down to where we can kind of make sense with the numbers and kind of take it from there. But like here in Florida, because there's so much demand coming into the state, especially in specific markets, you'll start to see cap rates will be a little bit more aggressive. And Midwest, there's more of opportunities out there, and of course that determines on the number of opportunities in there. So there may be a huge amount of inventory of Dollar Generals that are available in a certain market, which then will lower pricing as compared to some markets where it's a little bit tighter. Cost of land is more expensive. So there's not made much inventory available, which then will also determine the overall asking price for the asset. So that we can break down, and this is good because we're really starting to really granulate our data so we can get really detailed. We want to be kind of like the Zillow for net lease, and just really, but we're just shoving as much data in there. And again, we're open to any type of opinions on what would you like to see, so then we can kind of break it down for you. But yeah, we're well ahead of that that job, and we're just getting that, and we'll get that to you as soon as it's available. What's the best way to evaluate sale leaseback today, or sale leasebacks today? So I sold a large number of sale leasebacks over my career, and it's really no different than I would do it on any traditional, regular uh, transaction. It's just you're evaluating the tenant, evaluating the market, and the good thing is about the sale leaseback is that you're presented with an opportunity to review the lease, sign it, and then go to close. So we have a lot of clients that had some negotiation opportunity to say, hey, how about we add in, say, not this sub entity as a guarantor? How about we put in the whole guarantor? So there's a lot of different stuff that you can do. We negotiated. Replacement tenants. So there's clauses in there that if the tenant sold the whole business, the person that had the company that bought it has to have like a minimum of net worth or number of units guaranteeing it. So there's a lot of things you can do. We had on the last recent one was they had to have certain repairs scheduled and done prior to closing. So, lot of different stuff you can do there as compared to you buying into a property that's already pre-signed, it's active, and there's no negotiation. It's like either you like it or you don't like it. So that's a good thing about it. Why do companies do these sale leasebacks? So they'll own the real estate, operating the business. They have the ability to sell the real estate to you. They lease the property from you. They then take the capital that they receive from the sale and they can pay down debt, they can expand, and they usually use it to expand to more locations. So it's a good partnership. It's a good opportunity to get a fresh, brand new lease, usually very long term. In many cases, I'll see 20 years with rental bumps, everything included. So it's a good way to get like a very long term opportunity as compared to, hey, I just found something that has seven years and 4 months on it. So those are some opportunities there, and we've been seeing, at least recently, based off the data, that there's been some good negotiation opportunities. So we can secure some nice deals because right now companies need capital, they want to expand, they want to conserve, and then also be able to kind of move forward their business. So it's a good way to kind of get a good deal and partner up with the tenant. What was the last part I was thinking off of that? Yeah, it's just ways that you can look at the lease and just really make sure that it makes sense. Obviously, you can't just go say, hey, I want to be the rent to be 20,000 as compared to 10,000. It has to be reasonable, but at least you have that opportunity to go back and forth, opportunities that make sense for both parties. So that's a good question right there.
I also just want to point out too. I think it's very important for whoever is looking at a sale leaseback to have the proper attorney that's familiar with them. Because I mean, I don't know if you've seen the deal on your end, but some of the deals we worked with, a lot of investors or some of them that do sell leasebacks, the actual attorneys don't understand the concept of it. So then when they're negotiating for the investor, they don't understand how it's properly structured. That's where we have to step in and try to help them and guide them per se. Obviously, we're not attorneys, but we just make them familiar with the way that the lease is structured. But I think having an attorney that's very familiar with sale leasebacks, if a buyer is interested, it'd be very helpful for them at that point.
Yeah, well, it's the same for all deals, but yet particularly ones that are familiar with not just net lease, but the sale leasebacks and how it's structured. And what Quinn was kind of alluding to is that sometimes it may potentially stall or add in some complications that, and again, because this is all we do, and I'm so used to seeing this stuff, with the different clauses from the different tenants, and not only dealing with the company itself, but if you're buying a tenant that's also a national brand, they also have to have stipulations that has to be in the lease as well in order for it to go through, because them being part of their system of our brand, they need to have certain things in there that some of it's non-negotiable, some of it's hard to pull away from. So again, and this goes for all different types of properties or real estate, is having a very experienced attorney, so they can be able to help you along the process as smooth as possible. I've been in probably half of the deals where it comes in a standstill, where the attorney comes in and they're just not familiar, and then end up negotiating stuff into the stuff that was already previously agreed to, and that's a whole nother story for another day. But for your help, just again, just we can give a. I also have a net lease attorney checklist that you have as far as questions that you can use to ask your next attorney, or the ones that we refer you over, to see if it's ultimately a good fit. So again, I like the whole team concept. You want to have a good real estate agent, real estate attorney, mortgage lender, insurance, everybody in place, that everyone's on the same page, everyone's kind of familiar with the game plan, and to help your opportunity move along as smoothly as possible, as well as find any issues with it. So having a good one, they'll be able to find and say, hey, this is not going to work, and negotiate that out, or hey, we get the opportunity to leave the deal, and that's worth the money, to pay for those team players. How do I protect myself from tenant bankruptcy? So yeah, we've talked about a lot last week on several tenants that just went completely bankrupt. And again, it's unfortunate. And again, we have to look at this on a case-by-case basis, as well as find out what elements we need to do to protect ourselves in the same thing. I actually did a webinar on this for a client. We just went through all the different elements, talking about this subject. And it really comes down to just really looking at a lot of these lease clauses in there to make sure that you have the opportunity to replace the tenant, have any type of measures that's available to your local state to come after the tenant, to get any type of way to get out. It's just a lot of nuances, and I can send out the slideshow if anyone's interested in that. But it's really just come down to the due diligence and research. On top of that, not just looking from the tenant level as far as their ability to pay the rent, but also, do you have a good piece of real estate? Everything goes down to the real estate. I have cases where, unfortunately, some tenants didn't work out in the location, in that particular location, but the location fit very well for another operator to move right in with a different concept or a different niche or sector, and that helped to mitigate the risk. So along with looking through the financials, reviewing your lease, but then making sure, are we top to bottom? Does this have a plan B, plan A, plan B, plan C opportunity, instead of just having maybe the nicest shop way in the corner of this industrial section of town, or you want somewhere that's getting a lot of traffic. So the worst case scenario, if they didn't make it because of their business model just didn't work, or they had poor management, or whatever it is, that you can quickly bring in a new opportunity or have the opportunity to resell it. So you just want to look at from them standpoints. Is it guaranteed? No, anything can possibly happen. We've seen a lot of stuff, especially with the pandemic. We've seen a lot of movements going on with a lot of these tenants that were very vulnerable. We have ran down a different list of stuff. We just kind of alluded to it earlier in regards to their supply chain is totally dependent on foreign imports, which then affects his ability, then affects his customer base. So it's a lot of different stuff. So we want to look at it just so we have, all right, here's a list of good tenants that we said that can make sense. They're in the service-based business or the essential need. And then we look at the best markets, and we look at our plan A to plan C. And then we kind of make our calculations. And of course, again, everything's not guaranteed, but you kind of minimize your risk along with that. Anyone who have any questions in the meantime, just chime them in. Love to hear from you. If not, we'll just kind of keep rolling with this. And again, this is all going to be recorded. We're going to shoot this out so you have it. And to also make it easier, we're going to add in kind of the bullet points that we did talk about on the subsequent email. So you kind of have a rundown of what we covered. So if those are something that you're interested in or has some other questions you want to put in for the next show, just shoot it over. And again, if we don't have the exact answer right away, if it regards to like data or some type of legal stuff, we'll get back to you on that. And again, we're still working on timing to see if we have some people that can jump on to our stream, like our preferred attorneys, mortgage lenders, different people in different markets or different specialties that can offer some insight and some value to the call. Why are high credit tenants negotiating rent discounts? That just comes down to the performance of the tenant of that market. So we had, and especially during the pandemic, like tenants like Panera Bread, Dollar General, 7-Eleven had all called in because everyone was reeling at that time. So it obviously the high credit tenants, investment grade tenants are your best bet if you had to choose between like a franchisee and a corporate grade, but they're operating a business just like everybody else. They have their subject to competition. They're subject to market updates and shifts in demand and supply chains. No one is immune from it, even if they're very liquid and strong financially position, as well as they're being a smart business. So any tenant that has the ability to negotiate the cheapest rent or stay in your business for free, they will do it. So again, it really comes down to choosing really good high quality real estate where you know that there's huge demand in that market, that if they don't want to play ball, and again, this we're just talking kind of hypothetical, then you can replace them with another tenant in this particular case. But yeah, any tenant that have the ability to negotiate rent discounts will do it. And again, usually when you already have a tenant in place for a long-term lease and you have numbers that back it, you can, again, that's negotiation from that standpoint. Um, so it really depends on the particular situation, but not just high credit tenants. Everybody does it if they get the opportunity. And of course, as we start to see a lot more dynamic shifts in the market, that may or may not happen. But again, we want to monitor, but focus highly on the best possible real estate you can buy that gives you the ultimate leverage. So you know that you're protected either way, or be in the best position for negotiation. So that covers that. Let me go check my show notes.
Hey, Dwayne, I got a live question from one of the viewers.
Mhm.
Yes, is it common in real life where a tenant pays percentage of their sales to their landlord as a lease payment? Have you
Go,
traded
go,
in?
go again. I'm sorry, I couldn't hear you.
Yep, he said, is it common in real life where a tenant pays percentage of their sales to their landlord as a lease payment? Have you traded any of these types of deals before?
Not many, but yeah, there's percentage rent that are included, and you traditionally would see those are like in malls where you see like Ann's Cookies and things like that, where they're paying percentage rent. I sold a Burger King that had percentage rent. Not particularly the most attractive, because again, it's depending on the performance of the tenant. So they may have the base rent, which may be low, and then they may have like a percentage rent, which when you see any marketing packages, it will show that the average rent is this, but it's not really that because it's based off of historical trends that the tenant makes $1.3 million in sales, and a percentage of that goes towards the rent. So for our case, we like, and again, this is probably for like 99% of the investors that we deal with that buy into it. And the reason why they like it, because they like certainty. If they want to get into the game where they're going in and adjusting rents, they get into rental properties like multifamily, where you have the ability to change the rent on an annual basis based off of where the market is. So right now here in Florida, we're seeing to see rents go down. So we want to have where we have a long-term lease and it has built-in rent escalations, and you can forecast your income for the next foreseeable future. So there are opportunities like that, but it comes down to, is that really your end game plan? So you may see those opportunities with very high cap rates because of it has a higher, different risk. Again, that can be changed at any time depending on the market. We've seen leases where it has like it's based off of the local CPI, so it's like an adjustable scale. And again, is if you're more leaning towards, I'd rather know that $10,000 a month is coming in for the next 5 years, and then it bumps up to the 11,500, and then after that bumps up to 13,000. That's probably one that's more plentiful out there for as far as opportunity, predictability, and security, as compared to a little bit more of what's the word speculating, where it's based off of like the performance of the tenant. And unless you have a irreplaceable piece of real estate where it's like kind of like Disney, like there's going to be tremendous amount of people and they like guaranteed to make this income. It's not guaranteed. It's kind of like our last question where it's saying high tenant credit tenants are negotiating leases. So it's like, and that's always usually based off their performance, because tenants will come in and say, hey, I agree to pay this rent, and they'll pay it until they can't pay it. So we obviously want to get the best piece of real estate, the best performing tenant that matches well, that's fair to you as the buyer, or you as the tenant, them as the tenant. And then you have a nice long-term lease agreement between the both of you, and then it has predictable income. So those are available out there. It's not many. It's not really popular amongst the type of buyers we deal with. So if I had to choose between the two, I wouldn't recommend it. I would just go for stuff that, what is your end goal? Dwayne Quinn, I want $10,250 a month. I need that, to fit my lifestyle, and I'm done doing the landlord stuff. Then we can reverse engineer and say, okay, based off of that, that'll be 6.2 cap. You're going to deal with these type of tenants. This is the type of market. And then we can kind of structure it from there. But it's just more pieces to the puzzle with that, which most investors, especially that are attracted to this sector, are a little bit less likely to consider. So I appreciate the question, but that's kind of my take on it. Because there's not much upside unless, like I said, they're really extremely well performing. And even if they had the last 5 years, they were killing it. They can have bad management come in there. They can have something that just really deteriorate the store, that will kill the sales, that ultimately will affect your cash flow. And even through management, through financial, we want to put the tenant and you in a position that it's a continual cash flow stream without any type of disruption. So hope that answered the question. If there's any additional follow-up, or if I didn't catch it correctly, but from my understanding, that's what I think you were getting at. And again, that's the reason why I think it was like maybe a couple of years ago, it was like a Burger King we sold. But yeah, I wouldn't recommend it. That's kind of my take on it. Any more questions that he had or someone else posted?
No, that was the only one for now.
All right, perfect. So yeah, so that covers most of it. And again, like I said, we love this feedback. If you want to catch it, send it over live, perfect, or anything prior that does need like some data or further context, send it over a little early, and then we can kind of dig into it and get some further nuance. But other than that, I will jump into the quick presentation. There's only a handful of slides, and this kind of goes to the segue of what everyone was talking about earlier to what this gentleman was talking about. Is things about the lease. Whether you're buying a sale lease back, you're buying an existing lease, or in between, you have to make sure you look under the hood. So we probably seen on the open market, from you getting emails from us, going on Crexy, LoopNet, different broker lists, and getting a whole bunch of marketing material, and it all looks great. But you have to forget that first page on a offer all information package. It says you need to conduct your own research, and you need to do basically look under the hood. So you can't get upset if you read this and then you look under the hood and it says something a little bit differently and it ticks you off, and then you get upset with the brokers, and I'm cursing and I'm throwing my remote at the TV set. So our job, because like I said, our experience is just looking at a lot of leases over time, doing a lot of transactions and talking with a lot of attorneys on conference calls, and just kind of looking on their stuff. And I kind of have an interest in it because obviously our vested interest is to make sure that it makes sense so it can proceed to move forward. So we tend to look over time a lot of different lease structures, and not to be the all set all, but obviously to give more assistance or highlight stuff to you as well as your attorney to say, okay, here, this is a problem, this is a problem, or this makes sense, and we feel good amount of protection, and what the marketing material says is backed up within the lease and the due diligence documents. So triple net, this is a big one. Triple net isn't always absolute. So you have a lot of packages that say NNN or N, 3 N's, but there's always some type of nuance. It'll be NNN. Like if you see triple net, but then it says roof warranty on it. Well, then why say roof warranty if you ain't gonna be dealing with it? So it's like you have to kind of verify to see what they're referring to, because they'll say NNN, and the broker really means like, well, if you put the warranty in, it covers that. But then it's under your name if something more than say a dollar amount or something happened to it, or the developer's warranty expired, then you're on the hook for it. So we want to just make sure that is clearly spelled out, and nothing is wrong with if there's a double net or there's some type of landlord responsibility that's tied to a warranty. You just want to make sure that you're comfortable with it. It's clearly explained, clearly understood, and it makes sense financially. I say 95% of investors, they don't want to deal with anything. So they won't even want to hear the name roof warranty. They think that's a guy or something like that. So, because we dealt with the last couple months, couple calls from full warranty, but then we're on the phone dealing with the warranty guy, and we don't want to deal with that. And I'm pretty sure you don't want to deal with that either. So NNN, our absolute triple net, really, we want to know that if this is hands off, if we're just using this example to come to for this particular discussion. So what makes the true triple net? So, and it'll spell it out in there as far as tenant responsibilities and landlord responsibilities. So we're talking about taxes, insurance, maintenance, no capital expenditures, no calls, no nothing, roof, structure, HVAC, and everything. For some tenants, it'll be a triple net where the tenant is paying the bills, like for example, the taxes, but they may have a reimbursement structure. So you'll see for most Dollar Generals, they'll do the landlord has to pay the bill, and then within 30 days, the tenant pays you in full for it. In some cases, we have that bill sent directly to the tenant, and they get it in the mail, and then they pay it. So depending on how the lease is, it may be structured that way. In essence, it is a triple net because you're not responsible for the bill is not coming out of your pocket. But as far as the movement of capital back and forth, there's like an additional step. Some people prefer it, some people are okay with it, some people don't want to deal with it. So we just want to make sure that how that is looked at, that we also address that and just make sure that fits overall with what you're doing or what your game plan is. Because we had things where it's completely covered, and then they get the bill in the mail, say, hey, you owe the tax, and they call us and say, hey, I thought this was triple. And I say, well, it is. I said, just pay it real quick and then send the bill to the tenant. And they say, I don't want to even do that. And that's totally okay too. So we just want to make sure that's clear and aligned with your expectations. So again, that kind of goes a little bit what I mentioned earlier is about the risk of it. So you want to make sure it's clearly spelled out, and it'll take a while to look into the weeds of the lease and some of the legalese language, but you'll clearly show what is covered through the tenant and what is covered through the landlord. So you want to make sure that we're looking at it. And again, I look at it, quite a few of them, to make sure that it makes sense, but at the same time is also having an experienced attorney to also read through the legalese language to make sure that it's ultimately covered. So there's no surprises once we get towards closing or after closing. Yeah, and that includes an audit. And I just have these basic 4 questions, and I put this into a PDF. And yes, it's kind of straightforward and nuanced, but I did put it into a document where you can print it out. And as you go through it, we can actually go through it together on your next opportunity to make sure what's covered, what's not covered. We check off, and then be okay. Now phase 2, let's move forward. A good one at the end is the corporate guarantee, which also is a point of contention, because some investors find out that, oh, it says corporate, but then we found that it's a franchisee, and the franchisee on the package said it was, say, 80 units, and this one has some other entity that I never heard of. So we're trying to connect the dots and see who's owning what, because some of these entities may use a smaller entity as the guarantor rather than the huge parent company that we've kind of understood that's what going into, that's what we thought it was. So we want to make sure that's clearly spelled out, and then you're comfortable with that, because obviously one of the biggest cases is who's guaranteeing my lease. I'll make sure who's paying my rent is paying my rent, and you're clear about that. And that's one of the huge trip ups, and some people don't find that till like after closing, when they're like getting this LLC document, and they're like, "Who's this LLC? I thought it was such and such." So we want to make sure that's understood, and we go behind the veil and just make sure that everything is all clear and makes sense. Let me see here. So this is just an example. I think this was from last week. No, I think I updated this. No, this part of it was last week. So this is an example of a Burger King, 12-year term, and the landlord covers HVAC, but then it's only up until $1,000. So by a certain year, when they actually needs to replace, then a big bill is coming. So again, that's part of reviewing the lease to make sure that this is a potential issue. Either A, I'm comfortable with it, or B, I'm not dealing with this, and we can move on to the next deal. So we want to make sure that is covered, and it'll spell it out, and we'll make sure we can either get a direct answer in writing from the tenant to confirm specific things. We had a deal with, it was insurance, and the landlord had to get insurance, and it had to be up to a certain amount. And then we ended up finding out that the owner had a balloon policy that had over or other properties. So it was a big mess, and it wasn't revealed till late, and luckily we had caught it, but it did cost the new owner, to pay a higher premium than was anticipated, that wasn't spelled out earlier before. So the key is review it, ask as many questions before making sure your due diligence period goes hard, and then put you in a better position to either renegotiate or get out of the deal altogether, or you can anticipate there's either this expense or stuff like that. Because again, just because it has HVAC responsibility for the landlord doesn't make it a bad deal. We just got to make sure that it makes sense, and it matches up with your end goal strategy, which is kind of my repeatable talking point here. So why does this matter? Because again, as we start to see a lot of movement in the market, and once we start to see stuff adjust, And of course, kind of alluding to Quinn's earlier point of people are chasing yield and then finding the point in the middle where people are trying to make deals, that we want to make sure that we're not rushing into stuff. We're clear eyed with it and reviewing stuff and then making sure that we're clear. Everyone understands what the game plan is. We feel comfortable about it. And then it allows us to make a comfortable decision moving forward. Okay. So to the cap rate, and this kind of touch on the overall point of the call was cap rate is kind of relative, but then I always look at it is what's your overall end game. So obviously, in a perfect world, everyone can get a 10 cap, like Oprah's like you get a 10 cap, you get a 10 cap. Everybody gets what they want, but we got to look at it from expectations of what you want as far as your end goal. I will usually do it around a landlord. I don't want to be responsible for this for anything. Again, that's one of your goals. And I have an income goal. I have a goal of having a secure tenant in a nice location that's going to pay rent for the next 15 to 20 years. And it's going to go up 10% every 5 years, which is going to be a good hedge against inflation. So there's a good starting goals. And then we say, what is the market? It's ranging from 4.25 up to 6.5 cap rate. And they say, okay, this is kind of the range. And then we say, okay, this matches up with what I want. And then also your risk level of like, maybe I want a higher tier of cap rate, but then it's going to be a little bit more riskier tenant, maybe a secondary or tertiary market. So we look at it in that aspect, and then we make a decision from there. So because the cap rate may look pretty nice, but then we kind of find out that you're going to be responsible for a roof structure and parking lot, which costs money. So when you add that in and sprinkle everything in, your overall return will be lower. So we're paying for that at some point. And at the same time, we don't want to be getting a cap rate that's so aggressive with a tenant where it's putting undue stress onto the tenant to operate and pay rent, which then affects your ability to collect rent. So again, if the main goal is I want a long-term lease and I want cash flow, then you have to make sense that it has to make sense that it's relative to both parties. Because I've seen cases where, kind of talking about the sale leaseback, is that our client wanted to ask for a higher rent per month, and they went up a bit. But then I said, well, if we go too high, and then they actually accept that, and then they think that they have the ability to pay it long term, what happens if there's some type of disruption in their business or the economy? Then they're going to have issues where now they're going to call you and say, hey, I know we said $10,000 a month, but can you do $9,500? So we want to be in a position where both sides are successful. Obviously, you're the buyer, it's your money, and we put you in the position that will make sure that you win. But at the same time, we want to also be realistic. So that's kind of the final nail on the head with that one. So if you want a second eyes on the lease, you have a deal that you own, or we're looking at some opportunity, we could take a look and just give our take on it. And for the most part, it's going to be probably fine if we're looking at it from a grand scheme. There's just not going to be huge cases out there where you just have all these really bad leases. They may not be fair, meaning like you don't get everything you want or hope that you want, but for the most part, it's going to have good, proper protections for both the buyer and the tenant. But we also want to make sure that it clearly spells out what the expectations are from the beginning, and everything is who's responsible for what is also on there, and it's clearly spelled out. So that's really the key. A download that we offer. I put this, it's like probably 8 or 9 more slides where it has kind of all of the questions. If you want to give a copy, shoot me or Quinn an email and we'll send it over. I'm putting together the landing page, so all you got to do is just drop your email and name, and we'll send you a copy over with it. And again, if you want us to help you to take a look at your next opportunity, just give us a shout and we can kind of review it, just give some thoughts. But again, ultimately, we're not going to supersede an attorney's eyes, because ultimately they'll be able to really dig into the language and make sure that what's enforceable for your particular state and your local market. And again, a reminder of anyone who haven't got a copy of the book, the Net Lease Playbook. It's on Amazon. I think it's like $14. It's like 300 pages. We go through every type of buyer, from 1031 to passive investor to rental to landlord owner to net lease investor, and everything in between, from offers to due diligence to 1031 exchange to cost segregation to everything they think of in there. All my 15 years of experience all dumped into this book. And on top of it, if you send us an email, we're putting together a separate email list where we'll be sending out to people on that list of when we do webinars of us actually going into lease. So like actually going through a due diligence process with a client, and we'll just record it and then we'll send that to you. So you can say, okay, this was your A to Z step. We have a checklist that we go by. We're going to start filming us when we actually go to site tours. So some of our clients say, hey, meet me out there or go take a look at it for us. We'll go there, and either we're meeting the phase one consultant or we're on site looking at the roof, looking at the parking lot, just so you can kind of get an inside look of what to expect. And yeah, obviously they look very nice on the picture from the aerial shot on Google, but then when you actually go to the store or the building, it might be a different story, and then you might end up getting a different take. So it's always good to at least have an understanding of what to expect. And of course, some of our conference calls that we record with our attorneys and lenders, where they're kind of talking about these detailed subjects, and so you get an insight of what to expect on these calls, what questions to ask, what to expect from the next move, so you're on a proper path to make whatever transition, buy or sell, is as smooth as possible. So that was the last slide I had. What else did I had here? I think that was it. So
Thank you.
anyone have any last questions, just let us know. You said anything else popped in?
No, but I was just gonna say that a lot of this may seem overwhelming for new investors, but this is what we're here for. We're a buyer's brokerage, so along with the net lease playbook, me and Dwayne be able to talk to you, walk you through the whole process from beginning to end, send you up with the attorneys. We have a attorney referral sheet we can recommend as well. So, because a lot of times when we talk to investors, either they do 1031 exchanges, or this is the first one. They say, "Oh, I'd rather just buy." Another problem, like a rental property, it seems a lot overwhelming because a lot of them have families. They don't understand it, but this is what we're here for. So I just wanted to throw that in as well.
Yeah, sounds good. So, yeah, like I said, just reach out. And I forgot to mention on this last slide, if you shoot me that email, then I'll make sure that you're on that list. If I didn't say that before. And again, the book is available on Amazon. We also have some ebooks if you just are doing a 1031 and want kind of a good guide. I have, I think it's a 30-page guide on just kind of detailing the 1031 process as you prepare for it on your sale, all the way through to the transition period, and what parties are involved and who you have to deal with. So just kind of add that out there. So again, I appreciate it. Look forward to next week. Look forward to Monday's email with the net lease report. Tuesday, again, we're going to go live. And I'm kind of getting my final PowerPoint slides for the Wednesday webinar series. So we're going to have a webinar a week, just kind of diving through different topics. And June 4th, and I wish I had a slide for that. I think it's June 4th. What date is that, Quinn? The 4th?
Yes.
We're going to be in Indiana, speaking at the Mr. Landlord Conference, where majority of the audience will be existing and retiring landlords and I will be talking in my talk of the transition from should you keep or sell your rental property to then transition in that lease, as well as using the strategy of the 1031 to make that transition. So I think that's June 4th, 5th, and 6th, I believe. So
Yeah.
just look out for an email for that, and I'll make sure to have a slide on that. So then if you happen to be in Indianapolis, I'll get the details on the hotel and the tickets. But I think if you go to landlordconference.com, you can buy tickets, and it'll be great if anyone who's on this call I can meet you over there and meet you, that you can buy us dinner. So we will love that. So just joking. So, but again, pleasure having everybody on. Look forward to seeing you guys next week, and take care. Bye-bye.